All right, welcome folks. We're going to officially start here in a couple of minutes. I'm Tony Walker here at Tony Walker Financial, and this would be a big help. We know we've got some people already viewing. If you can hear my voice, the first one that responds and says, "We can hear you loud and clear, Tony," we're going to get you a Tony Walker bobblehead. So right here, we're on this camera here and says, yeah, by the way, folks, this is our second webinar. So we're in the studios at Tony Walker Financial, and we've got Aaron Orander, choreographer and producer of all the TV shows, radio shows. We've got Megan, who's helping, and then we got my favorite son-in-law, Trey, and we'll get to our guest in just a second. So we had anybody yet, Trey, that said the sound's loud and clear? Judy.
Ooh.
So how do we get Judy's information? We get our bobblehead.
Tell Judy to email AskTony@TonyWalkerFinancial, and we'll make sure we get her bobblehead.
So email Ask Tony, Judy, at TonyWalkerFinancial.com, and we'll get you a bobblehead. Go to AskTony@TonyWalkerFinancial.com, and thank you, Judy. We'll get started in just a second. Okay, that'd be good. Let's get after you. You ready? I mean, we got a good number of folks. Got a lot of folks expected. So let's go on and get started. So again, if you're just now joining us, you're obviously viewing our webinar dealing with Medicaid crisis planning. And we're very excited to have in our Louisville studios, all the way from Green Bay, Wisconsin, Mr. Tom Krause. Tom, thank you for coming down. You've had a TV show we recorded today, radio show, and now this.
It's been a busy day, Tony. I appreciate you having me. It's been great so far. So let's finish out strong.
Oh yeah, absolutely. We'll tell real quickly as people are coming on how we met. In our offices at Tony Walker Financial, we do a lot of retirement planning. In fact, June 1st, I just celebrated my 35th year in the business. Got in 1984. But we've done a lot of retirement planning, estate planning. One of the frustrations over the years is our clients have grown older. Some of them, unfortunately, have been forced to go into nursing homes. You got all this, what you like to call crisis planning. Everybody's scrambling, trying to figure out how to keep all this money out of nursing homes' hands. And we didn't have any answers. So I sent Heather, who's also a fiduciary in our office, out to Las Vegas for a random attorney, I think, was speaking.
Correct.
Yeah. Tell me that, and then how she met you. So tell us that story.
Sure. Well, it's an event that we co-sponsor. It's a Certified Medicaid Planner Symposium. Okay. So we have a relationship with that organization. It really provides education for advisors and elder law attorneys on how to add this piece of the practice to their business, the crisis planning piece.
Okay. And what we'll be talking about, folks, if you know anything about Tony Walker Financial, we do a ton of annuities, fixed interest, fixed indexed annuities. We do a lot of them. And what we found out is some of our clients had to go to elder care attorneys. Then the elder care attorneys were saying, well, these aren't Medicaid compliant annuities, which we knew that, but we thought, well, we don't know anything about Medicaid compliant annuities. We want to be there to help. And in some cases, it just felt like our hands were tied. We couldn't help. So, and we're going to get into that today. So Tom, your firm kind of came to the rescue. So although we're not affiliated with the Krause Agency out of Wisconsin, tell people who your two clients are. People like myself, obviously, advisors, but tell a little bit about your organization.
Yeah, well, we work in 48 states. So there's two arms to our company. The first arm is really dedicated to elder law attorneys. So we function as their back office for crisis Medicaid planning cases. So if they have a client in the situation, we put together a plan utilizing the Medicaid compliant annuity as the spend down tool. We also work with advisors like yourself across 48 states, and we provide them with the products that they're able to do this in their local community and service the clients and attorneys in the same manner.
Okay, great. Well, I think we're getting a pretty good response so far, Trey. People jumping on. Let's jump right into it. We're going to take no more than 15 minutes, I promise, to cover an overview and then also make sure you understand how we can save you or your family literally sometimes hundreds of thousands of dollars if this event arises. And we'll get to that. And then we're going to leave plenty of time, probably 15 minutes for questions. You okay with that, Tom?
Sounds good to me.
All right, well, let's start off for the basics. I think Megan got a good graph here behind us. Let's just talk about the whole issue of what's going on. Now, we quote this statistic a lot. 10,000 people every day turn 65. What is the significance for that statistics for elder care planning and Medicaid crisis planning?
Yeah, when we talk about that statistic in general, the fact that people are living longer, it brings about a problem with needing long-term care. The statistics show that 70% of seniors will require some form of long-term care in their lifetime, whether that's in the home, in an assisted living facility, or at a nursing home. And that's really what we're here to talk about today, is the nursing home stay. And why is it an issue? Well, it's an issue because of the costs. As you can see here, the average across the country is about $7,500 per month. So most families, this is going to be the biggest check they've ever had to write on a consistent basis, bigger than any mortgage payment, bigger than any college tuition bill that they've had to cover. So it's devastating for a lot of families because they'll understand very quickly having to write that check each and every month, they're going to go broke.
Yeah. And we talked about that. You know, in my business, it's so rewarding to be able to take money and send it back to folks. But when you put it that way, we did a recording earlier on a radio show this morning. I thought, you know, that is true. We just sometimes forget the opportunity or the ability to have to write a $7,500 check per month. Who in the world has to do that, especially on a regular basis? That's got to be the worst feeling in the world, and know that there's nothing you can do about it if you've already gone down that road without some of the stuff we're going to share today.
Yeah, and the statistics show that most people write that check until they ultimately end up broke. You know, with 50% of couples exhausting their entire life savings within 1 year of entering the nursing home, where 75% of individuals exhaust their entire life savings within 1 year of entering the nursing home. So with the average stay at 2.3 years, that's an issue. We need to try to bridge that gap and find a solution. And Medicaid usually is the solution that we're able to accelerate eligibility for.
Let's go to the next slide and get right into that, because the question is, who pays for this darn stuff?
Sure.
My wife has to go in, I have to go in, my parents. So what are the options? Let's go with those.
Well, the other public, that's the programs such as Medicare. It's really not designed to cover custodial care in a nursing home facility. That's more for acute care. So you break a hip, you are under doctor's orders, that will cover that type of care. But custodial care, that's really what the Medicaid program is designed to cover. And that covers the bulk of long-term care costs in the United States. A few other options, the other private, that would be long-term care insurance. But as you know, most people wait too long to get coverage when it's affordable and then get underwritten. And then finally, most people, unless you have a significant net worth, you're not going to be able to cover that $7,500 each and every month without pulling out assets. But most people end up paying out of pocket because they don't know there's any other solutions, and they end up going on the Medicaid program by default. But there's ways to accelerate eligibility for the Medicaid program while preserving assets.
Yeah, explain just Medicaid in general. When you say eligibility, how do I even go about finding out if I'm eligible? What types of facilities are Medicaid approved? Let's take somebody through that. All of a sudden they found out, my husband's got dementia. I cannot take care of him anymore. I've got all these assets I got to deal with. What is Medicaid? Kind of dumb that down for us and just explain Medicaid in general.
Sure. Well, the Medicaid program, it's a joint federal and state program. So the federal government put together a set of rules. The state, to take the money from the federal program, has to implement those federal rules. But each state has a little nuances in their program. So the planning that we do in Kentucky is going to be different than the planning that we do in Indiana. So the rules are a little bit different. There's both non-financial and financial requirements, and we'll talk about some of those here shortly. But that's how you really go about qualifying somebody for the benefit. And it's really designed to cover the custodial stay in a nursing home facility. So think room and board,
okay,
pharmaceuticals, incidentals, everything that you would expect to maintain living in a community going forward.
Yeah, so let's talk about that. So I'm looking at some of your notes here, which you provided some great tools. And folks, on the TV show, you can go to the YouTube channel at TonyWalkerFinancial.com and see previous episodes. We're going to be doing a live TV show recording of this whole episode of 30 minutes, in much more detail, more slides. But real quickly, go through the difference between the income and then the spouse at home. Oh,
sure.
Those issues. We got two spouses. What are they looking at Medicaid in order to qualify?
So the income test, there's actually two tests under the financial requirements to qualify for Medicaid. There's the income test and there's the asset test. We're talking about the income test. The Medicaid applicant, whether they're alone in this world or they have a spouse at home, their income can just not exceed the private pay rate of the nursing home facility. So for example, if the nursing home facility is charging $7,000, so long as they have income less than that amount, they're going to be able to qualify from an income standpoint. If there is a spouse at home, this is a great rule. Medicaid put into place some rules to protect the community spouse from becoming impoverished. So they set a floor income. So if the income falls below that floor, we can shift over income from the institutionalized spouse. But one of the beauties of this rule is there's no limit on the income we can create for the community spouse. So the community spouse can have unlimited income and still qualify.
Is this where we'll get to the Medicaid annuity later?
Yes.
So technically, yeah, good stuff.
Yep.
So keep that in mind, folks. Good stuff. Let's keep going on a little bit with the exempt assets. What are exempt from this whole Medicaid process?
Yep. Well, when we put together an application, they're going to look at your assets. They're going to say, okay, what's exempt and what's countable. First, the exempt assets are going to be assets such as the irrevocable funeral expense trust, both parties, both couple can have an irrevocable
Which
funeral
we do
expense
those,
trust.
by the way, folks. We can do these for you if you want to. And the trust that the company provides is free. So we can do those.
Yeah.
Up to, in Kentucky, it's
15,000 per person.
Yeah.
Yep.
Okay.
Then one vehicle of essentially any value. So it could be an older vehicle, a newer vehicle, you know, a Toyota, Mercedes, personal property. So things commonly found in the average household, furnishings, things of that nature. And then finally, the primary residence. So if there's a community spouse or a spouse at home, the property is protected up to any value.
Okay. Now let's go to the countable assets. What is that?
Yep. Well, these are the assets that we're more concerned about doing something with. If we have too many of these countable assets above certain limitations, then we're not going to be able to qualify. So these are things that you would normally think of, you know, cash, checking accounts, savings accounts, stocks, bonds, things of that nature, but also tax deferred annuities. Mm-hmm. And annuities that don't meet the requirements of deficit
reduction. So let me interrupt
Act.
you. So this is where sometimes the elder care attorneys have called us and said, you got to liquidate that annuity. Correct. So we can do what we're going to show you in a minute.
Correct.
Which is sometimes comes with pretty big penalties.
It does. So that's why you want to be very cautious of, you know, putting somebody into a product like that at a certain age range. And then finally, a second vehicle or a second piece of property that's going to be a countable asset.
Okay. So I thought what we do in the remaining time, we got about 5 minutes. Normally, if anybody watches my TV show or whatever, they'll know I love to go to the whiteboard. So this is something I've never let anybody do. I'm going to let you walk over to my whiteboard, and Tom's going to show us an example. So kind of scoot on over here, Tom, and let's go through this example.
Yeah, so in this example, we have a husband and wife. We have the husband, he's the institutionalized spouse, so he's the spouse in the nursing home facility. We have the wife at home, she's the community spouse. The husband has $1,200 a month in monthly income. The wife, the community spouse, has $1,000 a month in monthly income. The real concern here is the cost of care. This nursing home facility is charging $7,500 per month. So there's a real fear that they're not going to be able to cover this with their income alone. So when we look at what's the excluded assets and what's the countable assets, first, like we said, the home is going to be excluded. The vehicle is going to be excluded. The funeral trust for both parties will be excluded. So then we're left with, we have $500,000 in, let's say, a savings account. So this is money that's already been taxed. It's just already sitting in the savings account.
We're just using a real simple example. Go ahead.
Yep. So from here, so we said 500,000 is the issue. We can leave the community spouse with her deduction 126,420, which we said is the community spouse resource allowance.
So that's not subject. That's protected.
This is protected for the benefit of the community spouse.
Okay.
So we're subtracting that, and we're going to subtract the $2,000 that the institutionalized spouse is entitled to keep. So this is the individual resource allowance. So that leaves us with a spend down amount of approximately $370,000.
I'm excited about this presentation because I have somebody on the whiteboard that has almost worse handwriting than me. So this is great.
Yeah. So $370,000. This is the problem asset. This is what we have to spend down. So what we can do here is we can accelerate eligibility for the husband. We can get him qualified for Medicaid the following month to pick up the tab of this nursing home bill. So to do that, we're going to take this $370,000. Let's structure it into a 48-month MCA, Medicaid compliant annuity.
Can I interrupt you here? Because
Yes.
these annuities, the more I'm learning about them, you know, the traditional annuities we use, folks, are for retirement planning. Well, they could last 20 or 30 years.
Sure.
These are kind of the reverse of that. We're usually working, it sounds like, with shorter
Short
periods
term.
of time. So you're going to explain that. I think that's important to
Yeah,
note.
we can go down to 2 months. So we're going to have an annuity for 2 months. And as you'll see, sometimes it makes sense to go shorter.
Okay.
So in this case, that 48-month annuity is going to create a payment of approximately $7,800. And the wife is going to be the owner, the beneficiary, the annuitant, the payee. So between the $7,800 annuity payment we just created and then her income of $1,000, she now has $8,800 in monthly income. But like we said, it doesn't matter how much income we create for the wife. There's no cap on the income.
That's impressive.
So what do we do here? We were able to protect the benefit of the $370,000. We eliminated this off the countable asset sheet. We protected the $126,420 as a community spouse resource allowance. We structured this remaining asset of $370 into 48 months. That gave us, you know, savings essentially of the entire asset base, so long as she outlives the 48 months.
Yeah, so let's go. So let's slow down a minute. So let's assume she has to outlive the 48 months. But what you're saying is, this entire $500,000, really through this simple strategy, has been protected.
Protected it all, 100% of the assets, assuming she outlives the term.
Okay, and let's say she outlives the term. So I'm sure our audience, I thought this before I learned this. So flexibility-wise, can she do anything she wants with that monthly income?
Anything she wants. They're not going to reassess her asset base once
Okay.
we qualify the institutionalized spouse before benefits. So they're not going to go back and look at their assets ever again.
Wow, that's impressive. Well, folks, I hope you're enjoying this. We're getting ready to go to a question and answer. Let me share this. Trey, can you, we want to make sure we send them to the link. Can you put that up?
Yeah, I got the link on there.
Okay, it's already
In the chat box.
in the chat box. Okay.
We'll also send an email out after the webinar and make sure that they have that if they have questions or would like to meet.
Okay, yeah. So if you stay through the entire webinar, we're getting ready to go to 15 more minutes of questions. What we're also going to do, and you've approved this, we're going to send them some slides that cover this in some detail, right?
Yes.
We'll be happy to email that at no charge. If you want to work with Tom and learn more about it, you go through us. What we do is we do an initial planning session, then we bring the expertise of the Krause agency in to do the grunt work. Obviously, you don't want me in the trenches with you on this. This would, it's kind of like Connie at the office. Whenever we do a lot of paperwork on annuities, Connie says, Tony, just let me fill out the paperwork. Okay. But seriously, so what we'll do a planning session. So if you, a spouse, a parent, or you're concerned a parent is having some health issues, would that be a good description of who we're looking for to help here?
Yeah, exactly.
Okay.
We're going to look for the people who are in the nursing home facility. They've been asked to privately pay. So that's
Okay.
going to be the distinction. We're not using this as a tool before they enter a nursing
Right.
home. This is when they're in the nursing home facility. They're writing those checks each and every month.
Okay.
This
Now
is where the solution comes in.
And we didn't get into this, but that's where there's even, you say there's kind of a pre-planning. This is almost post-planning, isn't it? I mean, this is now the rubber's meeting the road. We got to do
Sure.
something. Yeah, we can do pre-planning, folks, with long-term care, the funeral trust arrangement policies. We can do that. That's kind of almost pre-planning.
Sure.
I mean, to the extent what you're going to do, what we bring the Krause agency in is that situation that's pretty dire. We're already there.
We always say when you're tired of writing those checks each and every month, come to us and we'll put together a plan to get you down to your, a very nominal amount.
All right, great. Well, let's see. I guess you want us to slide over here. Let's get back over here. Okay, Aaron's got us moving over here. So we're ready for some questions. We on this camera, Aaron? Okay, so we're ready for some questions, folks. Again, we're going to spend about 12 to 15 minutes and fire away. Do we have any over there, Megan, yet? We actually got a question, Tom. Here you go, right behind you. Is it too late to financially plan for long-term care? Well, I think you may have answered that, but let's answer it again.
Yeah, I think we just kind of addressed that, but no, once somebody's in a facility, that's when crisis planning comes into play, and that's why when the annuity really is a valuable tool when we're putting it together one of these crisis plans, because again, we could take somebody who's spending X for the nursing home each and every month, and we can reduce that significantly.
Great. Anything else, Megan? Here we go. Is it true that nursing home residents have to spend all their money on their care before they can qualify for Medicaid?
No, that's simply not true. Some nursing homes will have you believe that to be the case because it's in their best interest to keep you as a private pay resident for as long as they can, but that's simply not true. We can accelerate eligibility despite whatever asset base the client may have and despite whatever income they may have. So there's a strategy for pretty much everybody.
Would you say this? I'm kind of thinking out loud. There's got to be a ton of misconceptions about this whole realm of Medicaid and nursing homes and what's covered and spend down.
Sure.
Wouldn't you think? I mean, that's
ton
it's
of
like
bad
another
information.
world
Yeah,
almost.
a ton of bad information. There's just not many people that really specialize in just this process.
Yeah.
And that's what we've done primarily throughout over 25 years. So this is pretty much 99% of our business is dealing with this qualification process.
And, I've been a little fearful myself. Years ago, I spoke up here at a church in Louisville, and I was a speaker, and then I had a gentleman that was an elder care attorney. And when he talked about how frequently the laws change, obviously I'm not an attorney, you are,
Sure.
but I kind of just steer away from it because it does seem complicated, a lot of legalese. And I guess that's why now kind of hitching our wagon to you all's resources really
Sure.
give me more confidence to help a lot of our clients with this problem.
Yeah, well, it is definitely a moving target. We've been lucky. The rules have been very stable since 2006, which is actually the last rule set that we're currently operating under.
Okay, that's good.
So stability has been there for some time, but again, things change. It's not a stable set of rules. So you have to make sure you're working with experts to do this correctly.
Okay, you got a question?
Another live question. How would this work if someone's planning for a parent?
If someone's planning for a parent, you want to meet with the advisor or the elder law attorney who's ever involved in that instance. They'll put together a game plan. They'll look at the asset base. We'll do a similar calculation that we did over here, determine what's countable, what's excluded, and then we're going to determine what the problem assets are. And the advisor and attorney as a group can put together the game plan. Because again, we're going to have a perfected estate plan to do this appropriately, the right product, and then the right solution with the advisor.
You made a good comment. When you all started this, the founder, I guess, was into, quote, estate planning and found out that estate planning is not the same as this, right?
Well, he just found out based on, he put together great estate plans, but then they would blow up once the nursing home came into the picture. So he found a solution. Actually, on accident, he moved a home into a trust that created as a countable asset, moved the home out of the trust. It was excluded. So then he explored the Medicaid program a little bit more in depth.
That's interesting. Another question.
A couple questions on the look back period in regards to assets moved into an MCA.
Sure. Well, when you go to apply for the Medicaid program, the Medicaid office is going to ask you, have you gifted any assets or given anything away for less than fair market value within the last 60 months? And they're going to total up those gifts, and they're going to assess a penalty period if you divested assets during that time period. But with the Medicaid compliant annuity, because it meets the requirements of the Deficit Reduction Act, it's not going to create a penalty of any kind. So it's not going to be subject to a look back of any manner. There's not going to be any penalty associated with the purchase of an MCA.
That's what it finally, I got the aha moment. I went, wait a minute, there's no look back. It's as long as it's compliant.
As long as it's compliant, it's not going to be treated as a divestment for less than fair market value. So thus, it's not going to be subject to any penalties.
That's awesome. What else, Trey?
Is it correct that you have to go into an MCA after the person is already in the nursing home? Repeat the question if you don't mind.
Okay. Yeah.
Yes. So the question is, do we have to wait until the person is actually in the nursing home facility before we'll put one of these plans into play with a Medicaid compliant annuity? The answer to that is yes, because for multiple reasons. A, we want to ensure that because the product's irrevocable, because once we establish it, we can't take it apart in any manner. Okay. So we want to ensure who's on first base, who's on second base. So when we're, so that's the reason. It's not a pre-planning tool. It's a crisis planning tool. Somebody has to be in the facility because the product works as a solution. It has a specific goal in mind. Mm-hmm. So again, we want to wait till they're in a facility. They've been asked to privately pay. They've exhausted all their Medicare benefits. And now, the product comes in as a way to accelerate eligibility.
Anything else, Trey?
Another kind of follow-up to that, there's a question, is there any issue in moving from private pay to Medicaid paying if the facility has any issue with that?
You want to repeat the question?
Yeah, I've heard this some places where the facility might have issue with somebody moving from a private pay resident to a Medicaid resident. And they can't discriminate. Technically, they can't discriminate. If you're able to be placed in a Medicaid bed, they can't discriminate and tell you cannot apply because it's your right. But a lot of facilities want to make you believe that you have to pay privately for a certain amount of time, but that's simply not the case in most instances, so long as there's availability of a Medicaid bed available. So with that said, it's just, the private pay. Lost me here.
No, that's all right. All right. Next
Okay.
question.
Next question.
He's been, by the way,
Like I lost his eyes.
How much have you been talking about Medicaid today? I can't believe you're still going.
Okay.
Go ahead.
Are IRAs exempt?
Oh, Kentucky, the question is, are IRAs exempt? In Kentucky, the good news is IRAs are completely exempt for both spouses, both the institutionalized spouse and the community spouse. Whereas Indiana, there's actually a new rule just came into play where IRAs and 401ks are countable assets. We'd have to spend them down like we would any other asset.
Can that go into a Medicaid compliant annuity, an IRA qualified?
There's a tax qualified IRA,
okay.
a Medicaid compliant annuity, so we can roll over tax qualified funds.
Yeah, thank you, Megan. She put it that slide. Yeah, I think just to emphasize Kentucky. Hey, for once, Kentucky came out ahead of Indiana. No, Megan like that. That's cool. Yeah. So, any other questions?
Yeah, just questions on the fact that if a house ever must be sold, are there some provisions around that to avoid the sale of a house versus Medicaid?
Better repeat that question.
Yeah, so the question is, are there any provisions around the sale of a house, or will that cause any eligibility issues? Well, typically, if there's a husband and wife, we're able to protect the house up to any value for the benefit of the community spouse, the healthy spouse at home. So once we qualify somebody, we probably wouldn't want to sell the house at that point because then we might have to spend down those assets that we create. In the case of an individual, the house could be protected up to a certain limitation, but the problem is most people can't cover the carrying costs of maintaining the household. So you're probably better off to sell the house before you put together one of these plans and then use the cash assets to do a spend down plan like we talked about.
What you're saying. So yeah, you have a $500,000 house. You want to keep it maybe, but between property taxes, maintenance, insurance, I mean.
Sure. You can with the intent to return home, but most people, again, they can't justify or cover the carrying expenses. So they just sell the home. It's a much easier solution.
can you list the beneficiary, and is the money ever lost?
Yep, that's a great question. Can you list the beneficiary, or what are the beneficiary requirements of a Medicaid compliant annuity? Well, one of the requirements is that the contract has to name the state as primary beneficiary to the extent of benefits provided on behalf of the institutionalized individual. So in that instance, if we're purchasing the annuity in the community spouse's name, the annuity, they just have to outlive that term. So if they were to predecease the term, there would be a payback provision to the state. So again, that's why we want to select
really
maybe a
won't.
shorter term, so we can.
So it can't go to the kids, for instance. So it's like
It would. The kids would be secondary beneficiaries.
Okay.
So the only time you're able to name the kids or somebody ahead of the parents would be in a situation where there's a minor or disabled child at home. You could name them ahead of the state, or you could name the community spouse ahead of the state. But in most instances, the Medicaid agency is going to be listed as the primary beneficiary. And that's why it's important to select a term that we're confident the individual will outlive and that they're not going to end up in a nursing home facility within that time frame.
Yeah, because you're right, especially if we get into older years. You think 4 years is a long time, but it may not be depending on the situation. You got another one, Trey?
Yeah, this actually ties into what you just mentioned. Someone does have a disabled daughter, and she was wondering, as a widow, if she went into a nursing home, would the disabled daughter be able to stay in her home?
Ooh, that's a good estate planning question. I believe you're able to protect the home for the benefit of the disabled child. You'd have to set up a particular trust for that. But in that instance, we could name the disabled daughter as the primary beneficiary of that contract ahead of the state. So if she were to predecease the term, the balance of the annuity would go to the disabled daughter.
Let me interrupt. Can I ask you a question? Because
Sure.
we're starting to do a lot of these, the smaller life insurance policies that are, we'll just call them Medicaid compliant life insurance to keep it simple. So walk through that again, make sure we're clear on that. So it's $15,000. I pass away. Okay, is it technically really the estate? It doesn't really go to a beneficiary per se. Walk us through what happens to that $15,000 when I die.
Okay, so you're talking the funeral trust.
Correct.
So the funeral trust, that's designed to pay for final expenses.
Right. So my wife buries me and doesn't think much of me and puts me in a shroud, and it costs $4,000.
Sure.
What happens to the other 11?
I don't think that they're going to go back over that with a fine-tooth comb, but typically, that you're allowed to protect. They could, but generally that's not going to be the case. So you're just allowed to, protect that $15,000.
I need to tell my wife to have a big time funeral. For
Yes.
me. Nice casket, get it up to the $15,000. All right, so I'll make sure I'm clear on that. What to tell her.
Sure.
Okay. Anything, Trey, coming in? Any more questions? Megan, you got anything over there? If you got anything else? All right. Well. So one more call to action, Trey. If they want to, there we go. Yeah, basically, if you have more questions or want to meet with us, basically on any type of retirement planning, of course, but specifically on this, just go to TonyWalkerFinancial.com/webinar meet/ click on the webinar chat, or if you can just want to give us a call and talk. And again, if you have yourself, a parent, any loved one, you might have some relatives, going through this, and you happen to be watching this, and their friends and family have no idea that this even exists. So any type of retirement planning needs, as well as what we're talking about with Mr. Krause here. Is there anything else you'd like to add in closing?
No, again, this affects so many people, so I'm sure everyone's been touched by somebody entering a nursing home facility. I know you were telling me the story of your father. Both my grandparents are currently in a facility right now. So it does affect so many people. So if you're one of those people, definitely reach out to Tony, and we'll work together to put together a plan for your client to preserve their assets, have Medicaid pick up the nursing home tab. And I think, that's a complete plan.
Good deal. Thank you, Tom,
Excellent.
very much.
Appreciate it.
And keep in mind, that's next week, isn't it? That we'll have a live next week, folks, we'll have another live webinar. And actually, we're having a specialist come in from Atlanta, a Social Security specialist, Heather Schreiber, well known in the country as one of the leading experts on Social Security. She's going to be here for a 15-minute webinar, same time, same bat channel, 12 noon. To register for that, Trey, they can just go to the website now. Have we got that up? Yeah, so it's already on the website. Just go to TonyWalkerFinancial.com, click on workshops, correct? And you'll see it, Heather Schreiber. That's going to be a 15-minute Social Security. Doesn't matter whether you're retired, retiring soon, whether it's tax issues, whether you're not sure when to claim your Social Security benefits. Some really good stuff, and we'll do the same thing with Heather as we did with Tom. We're going to have a question and answer. So be sure to register for that at TonyWalkerFinancial.com. And thanks again for joining us. Have a good day.
Thank you.